Hello, and thank you for joining us for this Reed Smith webcast. We're joined today by Carl Frieden and Fred Nicely from Cost to talk about the 2018 Cost Sales Tax Scorecard, how states measure up. Carl and Fred, we're looking forward to talk to you about your experience preparing the scorecard and talking about what went into it and what we can look forward to in the future.
Thanks, John. Carl and I really appreciate being invited here. This is something that we could not do. When working on our scorecard, it takes a lot of assistance at practitioners, and Reed Smith was very valuable providing us information on the states. In addition, we get a lot of information from the state tax administrators, so I don't want to leave them out either, and thank them for all their work. When we're doing our scorecard, I think one thing that's really important, we always stress to the state tax agencies is that we're not evaluating them as administrators, we're valuing their laws. So our focus for our scorecards, it is directly to the executive branch and also to the legislators for those states to improve their law. And we've been doing this now since 2000. We started out first with our state administrative scorecard, looking at the state's general administrative practices, and we've had really big success. A lot of the states used to have a 30-day appeal period when you would appeal from something from the department to another tribunal. Now most of the states have at least 60 days standard. And another thing is, we've really focused in on the appeals, the first layer going to an independent tax tribunal, and that's something, John, we've seen more and more states go to, so that's been a real plus. The next scorecard that we did was related to unclaimed property, trying to improve unclaimed property practices. And then we did a property tax scorecard, and we've gone international with that, where we work with the International Property Tax Institute, and we not only evaluate the states, but we also evaluate some of the other countries and their subnationals and how they're doing in property tax administration. So we thought this was the right time to do a sales tax administrative scorecard.
So was there any particular nationwide trend or event that inspired you now to make this scorecard for the first time?
Yeah, I think one of the more important things is that sales tax is the most significant tax dollar-wise at the state level. Property tax overall for state and local tax, but sales tax is about a little over 20% of all state taxes, or sales tax is almost 5 times bigger than the impact on the corporate income tax. And so it's a very significant tax, the most important one perhaps at the state level. And also in the U.S., uniquely, it's a subnational tax. Most countries, it's at the national level with VATs. In the U.S., it's a state and local level. So given its significance was one, and then given the importance around the Quill and Wayfair and all the collection issues, we thought it would be very timely to try to look at how are states doing it and how can they improve the way how business and the states work together to get that level of improvement.
Great. So I guess moving into how you actually produce the scorecard, what sort of indicia were included and why, and were there any particular indicia not included? And also, why would we not use some criteria?
Yeah, so John, really good question. Unfortunately, we can't include everything. Looking at the overall sales tax administration, there are a lot of different components and all to it, but we wanted to make sure, we included some of the key items that reflects a good sales tax administrative system. So, some of the things that we focused in on is looking at how our business-to-business transactions taxed by a state. An ideal sales tax system, you're looking at taxing end user consumption. That's the big difference between a sales tax and a gross receipts tax. As a gross receipts tax, you don't have a sale for resale type of provision. So inherently, the sales tax is designed to try to tax end user consumption, but you'll see from some of our slides that there's no state that's perfect in only taxing end user consumers. The next thing is just looking at the overall fair sales tax administration, that you have procedures in place that are allowing businesses, purchasers, and purchasers that just self-accrue sales tax to be able to remit that as efficiently as possible. Centralized sales tax administration is another very big key component. If the state is going to have local taxes, all the sales tax collection, though, for the state and local taxes and the auditing, appeals, that should all be with one centralized entity, the state tax agency. Simplicity and transparency, making sure folks know what the state's sales tax rates are. This is very important when you have local jurisdictions, that you have a good database out there. And because tax rates, especially at the local level, can change, it's very important for the states to have historical databases. So that's something that we focused on there. Reasonable tax payment administration is, just looking at when taxpayers have to pay the tax. If you have to make multiple payments in a given month, that's an inefficient practice. Trying to make it so it's as easy as possible for the states in administering the tax and taking the payments in, and also for the sellers and purchasers not putting onerous payment requirements on them. Then looking at fair audit and refund procedures, one of the things that we are really concerned about is False Claims Act and class action lawsuits. And we believe that the states have tax administrators for a certain reason, and that is to make sure and verify that the sellers and purchasers are remitting the correct amount of tax. And having others try to administer the tax, that makes for a very inefficient process. We agree that there needs to be audits and all out there. It's just we think that it should be a state tax agency doing the auditing, and you don't need this duplication by trying to have third parties that don't necessarily have expertise in the state's tax system trying to impose the tax.
So I think, Fred, also, and it gets back to your question, John, just as important as what we were grading, or certainly very relevant, is what we're not grading, because we're trying to be objective as possible, and there's certain sovereignty issues. The states are allowed to do certain things. So one thing is, states' rates vary between, a couple percent and up to, 10% or more. And then some states have lots of local rates and so forth. We didn't grade states on their rates. That's their sovereignty, whether they want a high or low rate. And also with tax base, other than the issue of business inputs, which is really important because a good sales tax really should be based on personal consumption, not on business consumption. So we look at business inputs. Other than that, whether you want a broad tax base that looks at, taxes, services, and property, or whether you have a narrower one that's just focused more on tangible property, we're not grading that either. And so, and not only did we try to be objective on that, we also submitted the research and the answers on these multiple times to both practitioners and to the states themselves. And so, at least in terms of not necessarily picking the categories, but in terms of making sure we got it right in terms of what their responses were, what their laws say. We did go through a very rigorous process. The other thing we feel good about in terms of objectivity is that we have about 30 different criteria. Almost every single one of these, at least a quarter, sometimes a half or more of the states got it the way that we think that they should in terms of good sales tax administration. So these are not sort of far-flung categories that nobody can possibly qualify for. These are ones that we think are fair, but there's some great variation in the states, and that's the purpose of the scorecard, is to grade them on that and to try to get some improvements on those items.
Right, it wasn't done quickly. It took 2 years to get this done, and we were taking into account law changes that occurred even up to March of this year. So,
Fred, that's a really good point, because I think the elephant in the room about law change is Wayfair. How will, if at all, Wayfair potentially impact sales tax administration and the scorecard? Do you have to go back to the drawing board and start over, or is this sort of malleable?
Our point with the scorecard is that may be that the standard for simplification and uniformity passes Commerce Clause muster because of changes in technology and so forth, but it doesn't lead to a situation where we have a simple or non-complex sales tax. We have one of the most difficult sales taxes in the world, more jurisdictions than almost anyone else, more taxation of business inputs than almost anyone else, very little vendor compensation provided for sellers to get this all done. And so I think the timing is important here, because it's a really important message that it may be that the quill precedent changes, but that doesn't mean that we're dealing with a system that's very workable for both states and sellers.
Yeah, I think it's really important that our scorecard was not about whether or not states should have the right to collect from remote sellers, but focusing in on what is good sales tax administration, and whether you can have collection authority or not. What we really want to see is good sales tax administrative practices.
That's another criteria that we stayed away from. We're not grading the states on how aggressive they were on remote seller collection responsibility, click-through laws. We stayed away from that. I mean, again, that's a separate issue. What we're trying to do is, when that's all said and done, whatever the court does in Wayfair, there still is an underlying sales tax in 46 different states, including DC. How do we make that more workable?
Right. So I think one of the unifying characteristics we'll see, if any, is the role that sales tax plays in a state's budget and the revenue that they increase. I think, Fred, you had briefly mentioned, or maybe Carl, just say a little bit more about why sales tax now, why it matters, and why it might matter more to states now than ever before.
Yeah, and as Carl mentioned, the most important tax out there at the state and local level is the property tax. When you look at the property tax burden on businesses, it's actually 38%, but overall it's 31% of the revenue coming into the state and local governments is coming from the property tax. The next highest, almost tied with the sales tax, is the individual income tax at 23%, but still you can see 22%. Again, this is averages with all 50 states. So some states, such as Texas, are probably going to be a little bit higher because they're not relying on an individual income tax, and other states that do heavily rely on individual income tax, such as Connecticut, may be a little bit lower on their sales tax reliance there. But I also think it's important to note that you look at the sales tax, you look at the pie chart there. The blue is the percentage of tax collected by the business community, and then the red is what's paid by us as household consumers. And the sales tax, I think one of the good things is at least 58% of the sales tax is paid by end users. But again, the economists would say that figure should really be closer to 100% end user consumption. And we'll have some other slides that address the business tax on sales tax. Unlike the property tax, where you see that the business community is paying a lot more of that, typically businesses not only have to pay real property taxes, but are also paying the personal property tax on a lot of their equipment, and they normally don't have the type of exemptions for residential property, such as the homestead exemption that you see in some states.
Great. So without further ado, I think it's time we look at some of the scores from the states. And so I'm hoping that you can share with us, how do you actually go about scoring a state? Sort of what are the criteria? We know the criteria, but in measuring how they add up.
Yeah, so hopefully we can do a huge drum roll and everything else. So we're really pleased. We did have 4 states. They weren't A's, they were technically A minuses. And they all happened to be next to each other in the Midwest. So Indiana, Michigan, Ohio, and Wisconsin all did really well. You look at their overall administration systems, they're not perfect in every category. As we go through those categories, you'll see that they have flaws in some categories, but all in all, they're streamlined sales tax states. So that was something that was definitely helpful. And then they did quite well on the majority of the other categories. The worst states, Colorado, Louisiana, those are 2 states that have local administration. So that's something that really brought them down. And New Mexico just has a lot of issues in several of the categories that brought it down.
One of the things that's troubling on this chart is, some of our other scorecards, if you're familiar with them, there are far more states that get some A's and B's, unlike some of the administrative ones. This one, you can see a huge number, more than half, are getting C's, D's, and F's, and that's sort of the troubling state we are right now in terms of sales tax administration, and we'll break that down some as we look into what some of the categories are. If you go to the next slide, it's interesting to see Streamline, because Streamline has been a terrific effort of 24 states that have gotten together over the last 15 years to create a lot more uniformity and simplicity, at least within those states. Unfortunately, it hasn't been the bigger states, so it hasn't been California, New York, and Texas, and so population-wise, even though about half or slightly more than half the states are streamlined states, population-wise, it's about 68% of the population is in non-streamlined states. And what's interesting, if you look at Streamline is important in our scorecard, but only about 1/4 of the criteria, about 30 things we're looking at, only about 1/4 of them are streamlined. However, if you look at the results, both because those streamlined states do well on that, but they also do well on some other things, the average grade of the 24 streamlined states is a B. The average grade of the non-streamlined states, and this includes the biggest states in the country, is around a D+. So there's a huge difference, but it's really important to note that this is not just about Streamline. This goes far broader. Their category Streamline doesn't look at business inputs and whether states are taxing them. It doesn't look at vendor compensation. It doesn't look at some of the complexities of centralization, whether states are centralizing enough or have too much local autonomy, which is making it more difficult to comply. It doesn't look at a lot of those other issues, not because they didn't think they were important, but they get into sort of more political issues. It's hard for the states to have consensus on. So we're looking at something much broader than streamline.
So what impact at all, right? So in theory, the streamline is great because it creates uniform standards. But of course, it doesn't have the authority to make a state do something. So how, if at all, would it impact a state's score if they were out of compliance with the streamline agreement?
That's really a good question, John. Unfortunately, we do have one state, Georgia, that's out of compliance. They have several issues, but one of the big ones for the business community is they have a good faith requirement when a seller accepts an exemption certificate, which means that the seller needs to police the person who's claiming exemption and whether or not it's reasonable for the person to be able to claim that exemption. And that's really a hard burden to put on sellers, especially remote sellers who have no idea the context of how something may apply in a state. So that's an area that we did take in consideration. Another state, Tennessee, it's an associate member state. Every 2 years, they have a law that decides whether or not they're going to become a full member, and typically they delay. I think they're waiting for Congress to act. So that's another state that did not, get 0 points for being a full member streamlined sales tax states. But both those states, overall did much better than the states that were not members at all, because they are complying with other components, a lot of the uniformity provisions.
Great. Well, I think with that big picture overview of the inputs and how you guys came up with the scores and looking at some of the states and how they fared, it probably is best to now turn to particular categories. So Fred, can you help us understand the business-to-business transactions, that exemption, and how you score that and why it matters?
Yeah, so thanks, John. We get into the nuts and bolts of the scorecard. So as you'd mentioned, business-to-business, this is our first category that we had. And we did a study a couple years ago looking at what is the percentage of tax that is being collected from the businesses versus from household consumers. And we're pleased that we were able to do that with E&Y. And we were able to get that updated. Just recently had new numbers, and we will be coming out with a new study, we hope, by the end of this year. And 2 points were assigned to the overall percentage. If it was less than 35% coming from the business community, it was 0 points. 35 to 45, 1 point, and over 45%. Unfortunately, there's too many of those states. They received 2 points. Then the manufacturing exemption is something that's really important in looking at business-to-business inputs, because it's the start of the overall cycle to making tangible personal property. Looking at the breadth of a manufacturing exemption, that was 2 points. And then looking at the manufacturing inputs and how broad that applied. Almost all the states, the actual material that's incorporated into a manufactured item, that's usually exempt, but some states don't exempt energy and other items that don't directly become part of a product. So that's something that you'll see when Carl goes over those specific items. And then last but not least is many states are taxing services now, and we don't take a position on that, as Carl had indicated. However, some states are taxing both the input, the equipment used to provide a service, and also taxing the output, the service that is provided to customers. We don't think both sides should be taxed. That's not a good sales tax system. That's inherently creating some pyramiding. So we address that.
Yeah, so John, just in all of these maps, by the way, are available. This whole study is available at the COST website, www.cost.org. And so feel free to do them. We'll just give a little bit of flavor for these because, we don't want to go into complete detail in different states. But as you can see from the first one, this is how well states do or how poorly they do in terms of taxing business incomes, because most people would agree, most economists and other administrators would agree that a good sales tax system is supposed to be on personal consumption, not on business consumption, and certainly not pyramiding or double taxing. And what you can see here is really there's no state that gets it right. I mean, the lowest state in terms of how much of the sales tax is collected from business purchases is Idaho with 32%. It goes all the way up above 60% with New Mexico, and so and the average is around 42%. And this is where the U.S. is really worse than everyone else in the world, because almost everyone else has a different type of a consumption tax, of a value-added tax. But the way those work is you tax business inputs, and then you get credits back on those taxes if the output is subject to tax. So it's a system that's built around not pyramiding or double taxation. We don't have that, unfortunately. The next one shows, again, the same type of thing working in manufacturing. Most of the states have agreed historically, because a lot of the sales tax started on manufactured goods, that there shouldn't be pyramiding of taxes here, that business purchases of equipment and materials should be exempt. However, if you look at the performance, the states in light blue are ones that have either little or no exemptions for equipment used in manufacturing. Most states do, and so there's a there's a range of grades on this one. But really, all of the states should be in the darker colors here, or actually in the peach color, where they have exempt everything that goes into the business input. That's what most of the rest of the world does. We don't do that. And then finally, on the last one, I think, Fred, you were going to discuss this one.
Yeah, so there's a lot of services that states are taxing out there. We tried to pick some of the big ones that are common for states to be imposing their tax on. So we looked at the wired, wireless telecommunication services, cable services, and electric and gas services. And the states that are taxing both the inputs, the equipment used to provide those services, and also the outputs, taxing the end user consumers when they provide those services, those are the states that are in the dark green color. So those are the states that we would like to really see some changes. And again, we prefer that if a state's going to tax a service, that it be on the output side. But some of these states, you can see there's a lot that are taxing both the equipment used to provide the service and also the service at the output.
So let's move to the next category, the Fair Sales Tax Administration. Carl?
Yeah, so just briefly on the categories here, and a lot of what we tried to do was come up with sort of reasonable proxies or certain criteria that we thought were reflective, because we could have gone at other criteria as well. One of the most important things in terms of Fair Sales Tax Administration that we hear both from companies and from the state governments that have to deal with it is exemption certificates. There are a lot of exemptions. The exemptions vary by state, and so it's really important that there be some ease of compliance in terms of dealing with exemption certificates. So states that didn't use uniform ones, whether it was the MTC or the SUDA one, were got a point against them if they didn't allow sort of ease of administration. If they didn't allow you 120 days, which is sort of a standard thing, to go back and find an exemption certificate if you didn't have it, we would grade on that. So there was grades on exemption certificates. There was grades on vendor compensation. Again, the studies that came out that were done for Streamline showed that anywhere from 2% to 13% of all costs of businesses in terms of a share of sales tax collected, it ranges between 2 and 13% is the cost to business. This is a trustee tax. Businesses are doing this on behalf of the states. Generally, it's not their own liability, and therefore there should be some compensation for that. And so that was a criteria. And then finally, direct pay. Sometimes it's just easier for the consumers, particularly large businesses, to directly self-report use taxes and or sales taxes, and the states that made that easier were given credit, and the ones that make that harder were dinged with a point. So.
Great. So Fred, maybe share some experiences on the good faith requirement and the vendor compensation.
Yeah. So thank you, John. The problematic states are the states that are in blue. Those are the states that are imposing the good faith requirement. And I have to tell a little story from my days when I was in Ohio, and this is going back to about 2003. And Ohio was contemplating becoming a streamlined sales tax state and changing its laws so it would comport to the agreement. And I remember a lot of the conversations dealing with the sales tax auditors and the debate on whether Ohio, should do away with its good faith requirement on the acceptance of exempt certificates. And Ohio was a really tough state, because if you didn't get an exempt certificate, you also had to go further and you had to get a letter of usage from the purchaser to actually prove that the sale was exempt. So the sky was falling when Ohio initially changed its law. I'm pleased to report to you, though, that was back in 2003. 2018, Ohio, does not impose the good faith requirement along with the other streamlined sales tax states, and they're not having any problems. Ultimately, who owes the tax? It's the purchaser. And I think the states, especially the streamlined states, they're going after the entity that truly owes the tax. That's the purchaser. So if they wrongly claim an exemption, they're rightfully assessing the purchaser for additional tax and not dinging the sellers if they have a valid exempt certificate. Now, of course, they can't commit fraud. So that's very clear in the agreement themselves that the seller can't induce a purchaser to claim an exemption that they're not entitled to. But not having a good faith requirement has not caused the sky to fall, and the states are still collecting their sales tax.
Good.
And then the next thing is, Carl touched on vendor compensation, how that's really important, that there be some reimbursement for the sellers to be forced collection agents for the states. And the criteria we used, quite frankly, I think was pretty low. We used as the minimum standard for a state that's in the uncapped vendor compensation threshold is that all a state had to do, if it only has one rate per state, just a state rate, is a 0.5% compensation. And then the states that have local taxes, they had to provide at least 0.75% compensation across the board without any caps. And that was based off the streamlined sales and use tax agreement when they used to have a provision in there for compensation if the states got remote seller collection authority from Congress. That provision is no longer in the agreement, but we use that as their threshold. And as you can see, there's only about 8 or 9 states there that are in the uncapped vendor compensation threshold. And a lot of the streamlined sales tax states, they failed to meet this vendor compensation requirement.
Great. So moving along, Fred, maybe you can tell us a bit about the Centralized Sales Tax Administration category.
Yeah, Centralized Sales Tax Administration, again, if you have to deal with the state and then over 100 local governments in trying to administer the sales tax, that's going to be inherently inefficient. When you have to file the tax, it's inefficient. When you have to try to appeal a tax, it makes it very problematic. And you can have different answers, locality to locality and locality from what the state has to say. So that's something that we definitely wanted to evaluate. One thing that I thought was really noteworthy, John, here is that we also look at the number of local jurisdiction a state has to its overall population. And there, the barometer that we're looking for is that if you have a plethora of sales taxing jurisdictions and there's not a huge population base there, that only is a cause for problems too, where you're going to have problems with the sellers to be able to accurately determine what's the right location. If you have a minimal population base there, it just doesn't make sense. We don't see that as a good administrative practice.
So what were some of our experiences when you took a closer look at the number of states with locals and then also based on population?
Yeah, and I think an important point here is that we are not judging states on their specifically on how many jurisdictions they had. It's a matter of sovereignty, just like rate and tax base generally is. But for those that didn't have central administration, and so there's 4 listed here that have local administrations, sometimes local appeals processes, they were definitely dinged. I mean, that makes it much, much more difficult. You can see here that there's only about 10 or 11 states that don't have local taxes. If you go to the next slide, really what we came up with a proxy on this is we don't even know exactly the number of local jurisdictions, somewhere between 10 and 12,000. This is, again, a uniquely U.S. thing. There are very few countries in the world that have local jurisdictions. It's almost all national consumption taxes. And so it's uniquely American. We didn't ding the state specifically on that, but if they had multiple jurisdictions over 50 and the average population in those jurisdictions was under 20,000, we thought that was unduly burdensome. And in fact, a good percentage of the states, the ones that have sort of the crossbars on them, over a third of the states fit that criteria. So again, we were trying to be balanced and fair here. It's state to determine how many local jurisdictions they want, but at some point it becomes a very, very burdensome system.
Great. Well, the next category, I think there are 2 things that everybody wants: simplification and transparency. Carl, briefly on this category.
Yeah, so I mean, what we did, the proxies for this one was Streamline was the first one. I mean, Streamline is the best uniformity effort we've really ever had in sales tax, and almost slightly more than half the states have signed on. So if they did, they got no points. If they didn't, 2 points. So that was in categories that got 2 points in this, were ones that we considered more significant categories. A lot of them were just dinged 1 point for some of the other ones. Uniformity within definitions and so forth, aside from Streamline, we also wanted to look at that. And so an important category was digital products and the use of software that you get digitally or electronically. And here again, we didn't take a position if the state taxed it or not. That's their sovereignty. What we did look at was, are they being clear? Is it transparent? Is there a statute that says that you can tax digital goods, audio and video? And if there wasn't, then we dinged them a point. If they didn't tax it, they didn't get any points, and if they had a clear statute on it, that was fine. Yeah. And then the final thing was just liability relief. Do they provide liability relief if you follow their statute and you're still subject to tax?
Yeah. So we focused a bit on Streamline. Let's maybe go right into the software. I think that's interesting and an emerging topic.
Yeah, and John, one thing you've heard from both me and Carl is that we're not penalizing states because they tax certain things. So by all means, states that want to tax merely accessing pre-written software, that's fine. But if states do it, we think it needs to be done via clear legislative authority, not tax administrators trying to interpret the law, because oftentimes it's a very unclear area. And most importantly, especially when you're dealing with the accessing pre-written software, it probably makes sense for most states to do that as a service, which almost requires most of the states, because they only tax enumerated services, that do that via legislation.
Great.
So maybe perhaps in the interest of time, if the maps are all available, maybe for the last three categories, we can just briefly describe what are in those categories.
Perfect. So Fred, this reasonable tax payment administration, if you can describe that, and maybe say a word or two of the private label credit card.
Sure. So advance payments is, some states, we think it's unnecessary for them to have more than one advance payment per month. Ideally, they shouldn't have any, but if they're going to do it, we like to see that the advance payment is tied in when a business actually has to file their sales tax return. That's the easiest compliance-wise. And then full credit for other states' sales and use taxes. One issue that we really like to highlight there is a lot of the states, when you look at the credit they apply for other states' taxes, it's in their use tax provision. A lot of states are getting more aggressive that they can impose their sales tax rather than use tax on certain transactions, so it makes it problematic for businesses and for consumers who paid sales tax during the jurisdiction to properly get credit. Then periodic lease payments, we think the right way for periodic lease payments to be subject to sales tax is when each periodic lease payment is made, typically on a monthly basis. Some states accelerate that. So the states that do that, they are given a point. And also another concern is some states don't provide credit to the states that do have the accelerated sales tax. That's a problem too. And they're given a point if they do not provide credit. And then lastly, just looking at private label credit cards, there's been a lot of litigation in this area. A lot of the tax administrators have said that their law doesn't allow for it. We think this is something that's important. Where you have a private label credit card situation where you have a credit card company that is working with a seller and using the seller's name on the card, and there's an assignment to the seller on the purchases that are made on that card. We think that seller should be entitled to a bad debt deduction in that case.
Great. Carl, we'll go to you for our second to last category, fair audit and refund procedures.
Yeah, thanks, John. So, again, here, a lot of our criteria on all of these is dealing with the reality, really, that sellers are supposed to be collecting on behalf of the state, that it's typically not their own liability. And so what are fair rules of the game to make it easier for them to do it and not to put onerous burdens on them? So on this one is for purchasers, and this is more on the purchaser side, if you have to go to the seller to get the right to do a refund, it's very cumbersome. Most states allow the purchaser just to go directly without the seller getting involved, because that gets the seller involved in a lot of information they may not have. So we did grade the states on whether the purchaser could go directly and request a refund. Another really important category is all states have very developed systems for administrative appeals, both for audits and for refunds, through the Department of Revenue. Those states, it's still a minority of states luckily, but those states that are using either false claims acts to go after, to allow outside parties, and sometimes AGs, outside the regular administrative channels to go after companies typically when they undercollect, that's really difficult for companies to deal with, and the vice versa, class action suits when they overcollect. So the theme here is use your normal administrative channels. Don't allow sales tax administration to go outside of those except in very, very exceptional circumstances.
Great. Fred, our last category.
Yeah, so our last category is sometimes you just have some issues that don't nicely fit in the overall scorecard, but they're important to note as a concern. So there are several states that still require Social Security and home addresses of corporate officers. So that's something that we highlighted. And then there are other states that just have some nuances and all in their law. And one thing that we pointed out as Georgia, they, by regulation, they're denying direct pay permit holders interest. So that's something that we noted there. So some of those nuanced issues and all. And we, again, John, we hope to work with the executive branch of the state's governments and the state legislators and improving their sales tax administrative practices.
Great.
And
Well,
one final comment is, we're certainly open for, we think we got this right. We've probably made some errors. If you see any errors in it, please address them. They generally won't affect an overall grade since there's so many criteria there. There are other things, either from the state or business side, that you think are good things to be grading states on. We will, certainly, modify this in the future if we find other better criteria. The idea here is just to come up with a composite of criteria that really are the most important, both to the states and businesses, that can make life easier on both sides for sales tax administration.
great. Well, Carl, Fred, we really appreciate your time and you joining us today. We'd like to thank you not only on behalf of Reed Smith and the viewers, but the state tax community at large. You certainly provide an invaluable service, and we'll all be looking forward to see how the scorecard develops in the years to come.